Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's long video, as I did last month, I'd like to discuss what we are seeing in our MATA SII charts to put them into an integrated context. As such, I'd like to cover those items listed here. Last week was the best week since November for U.S. stocks, yet the global economic surprise data has now been negative since April 2018, the longest period on record. Negative macro surprises are a result of China-U.S. trade war intensifying, and it appears China is now preparing to take the long road. Trump launching a Mexican tariff threat, which has subsequently subsided, at least temporarily. Trump has launched an India trade war. U.S. labor market with May's non-payroll labor report is now beginning to crack. U.S. GDP is slowing. German manufacturing is collapsing. South Korean exports have dropped to such a level that they need bigger charts. Global PMIs are plunging. Bond yields are crashing, etc. However, bad news is good news once again. We will explain why and what to expect going forward. Let's start with fundamentals, risk, and sentiment. For years on these videos, I have begun these videos by stressing that fundamentals are about the long term, risk about the near term, and sentiment is about the short term. When they all strongly signal the same thing, then major reversals soon occur. Those reversals come in two forms. For tops, they are a process. For a bottom, they are an event. We show here the number of U.S. hours of work needed to purchase the S&P. The monthly S&P 500 time series is deflated by the average hourly earnings of production and non-supervisory employees. We see the S&P is currently at a level of extreme valuation. Stocks eventually have to track the economy, but do often diverge for periods longer than most short sellers can remain solvent. We respect that and tend not to fight the market until it shows signs of cracking. Easier said than done, however, as the algos have mastered the art of setting bear traps. Profits don't grow to the sky and are subject to economic constraints. Squeezing labor costs to further increase margins creates not only political conflict, but tips the economy into a nasty feedback loop of weak demand, lower capital spending, and more cowbell buybacks. The end result is punk economic and top-line growth, further forcing firms to increase margins by additional cost cutting. We have written extensively about the level of corporate debt globally and the growing size of zombie corporations. As big as U.S. corporate debt has become, primarily as a result of U.S. stockbacks, it pales in comparison to other countries. China, a smaller economy than the U.S. economy, has by far more non-financial corporation debt. In U.S. dollar terms, corporate debt in China hit a record of $21.1 trillion in Q1 2018, by far the most of any country. But since then, Chinese companies have been deleveraging under orders from the central government. Deleveraging takes many forms in China, including defaults, state-mandated loan-to-equity swaps by Chinese state-owned banks, and bailouts by the central government, which includes the People's Bank of China. In Q4 2018, China's non-financial corporate debt, the red line, was $19.8 trillion, with efforts to deleverage in Q4 having taken a back seat to efforts to boost the economy. Meanwhile, U.S. corporate buybacks only continue to grow and set yet more records. We like the Buffett indicator, that is, market capitalization to GDP. Market cap to GDP is a long-term valuation indicator that has become popular in recent years thanks to Warren Buffett. Back in 2001, he remarked in a Fortune magazine interview that, and I quote, "It is probably the best single measure of where valuations stand at any given moment." End of quote. This macro metric additionally illustrates stock valuations are at historic extremes. Turning to risk, we see historic monthly equity outflows as markets have been rebalancing to the Treasury market as a percentage of assets under management. The latest half-year outflows were only exceeded by those seen around the 2008-2009 recession and the European financial crisis. At MATA-SII, we watch closely the activities of the CTAs, or Commodity Trading Advisors. The CTAs track the ISM Manufacturing Index, and in fact, weak U.S. economic momentum, which we currently have, typically supports systemic trend followers or chase selling. Because CTAs move such large amounts of highly leveraged money, they move the markets in the short to intermediate term timeframes. We've been highlighting in the Under the Lens monthly macro videos the fact that the political polarization and gridlock is becoming increasingly the norm. This is like sailing in a storm with the helm locked. Geopolitical risks of miscues is rising at unprecedented rates and could trigger a major financial crisis at any moment, with global economies presently so fragile. The MATA-SII tipping point and Under the Lens macro video contents are becoming increasingly more concerning and reflect the global risks at extreme levels, historically often seen prior to military conflicts. Sentiment and consumer confidence. This is the area to really focus on, and is why in our monthly LONGWave videos we normally show so many charts. This month I will limit them to only 4, since we have shown in previous videos that we see strong signs that the consumer investor sentiment and confidence has topped and is reversing downward. This recent chart from Nomura compares present U.S. equity market sentiment to that seen prior to the run-up to the 2008 global financial crisis. The U.S. equity index looks to follow the pattern from 2006 to 2009. If this continues, it suggests we may see an overall rally like 2008 into the fall before collapsing. Global equity market sentiment continues to deteriorate and has went negative on a one-year rolling basis. The equity market shows a similar deterioration. As Bloomberg reports, the S&P 500 has sunk to a 20-month low according to a weekly survey by the American Association of Individual Investors. So we have fundamentals, risk, and sentiment all at extremes. Since tops are a process, let's see if we have that underway. But before we do, let's consider a few key market drivers first. Yields have been plummeting. Treasury yields are now the most oversold, bonds most overbought in 21 years. As shown here, not only the bond volatility, that is the MOVE index, but volatility everywhere has exploded higher for all financial instruments except for equities. Credit spreads have widened. High yield spreads have widened with a falling S&P 500 until last week, when both reversed upward, suggesting liquidity injections have accelerated. Commodities expectations continue to be taken down. The behavior of commodity prices, along with the U.S. dollar curve, both continue to suggest a more durable downtrend in both places. Not transitory, this globally synchronized downturn, which has stalled economic growth everywhere, still very likely is in its beginning stages. If the U.S. labor market isn't actually strong and Chinese monetary authorities aren't actually stimulating, it's hard to argue with commodities. Inflation. Expectations continue to be taken down. All indications to MATA-SII are for the real possibility of a stagnation shocker. Inflation, as we have written about and released macro analytics videos on, is currently about services, not goods. Service is domestic and not normally imported. Goods are global and in the U.S. are dominated by imports. Service inflation continues to increase. Soon goods will increase due primarily to trade tariffs and a weakening U.S. dollar, that is centered around de-dollarization. Drivers in terms of U.S. dollar weakness we're seeing. International carry trade investors typically hedge their holdings of foreign bonds using derivatives as a currency hedge. This allows them to borrow foreign currency in exchange for their own and lock in a future interest rate. This practice has recently been jettisoned in an attempt to capture higher returns. The current shift in trend leaves global investors exposed to a falling dollar shock. We're in an era of intervention, in actual fact. What is happening now is we have central banks intervention again. We strongly believe we have entered this era of continuous and sustained market intervention by global central banks. Because of this, lost is the pricing of risk, lost is the market price determination, and lost is any semblance of sound money. This is now advanced macroprudential policy, or what was commonly referred to as financial repression, and will soon be financial repression on steroids. QE, QQE, and further untested and unsound monetary and fiscal policies are ahead, including MMT and bogus concepts such as QE for the people. The most recent intervention occurred with the May market lows. It has accelerated since, taking the equity markets with it. What drove last week's unprecedented surge in stocks? Intervention. And 13 Fed speakers all singing dovishly from the same plunge-protecting hymn sheet. Once again, bad news is good news. We have been posting this US dollar DXY chart for a couple of years now. It has been very accurate in warning of US dollar moves. Recently, the issue has been whether the DXY continues to follow the ellipse ring higher or separates from it. A separation is most often a warning of the beginning of a falling trend. The DXY has now separated from the ellipse. The likelihood is for the DXY to fall towards the center line or bottom of the red channel shown here. The dollar has been experiencing a flight to safety in the first half of 2019. This may be coming to an end as investors realize that secular and structural forces are beginning to converge on the economy and market, such as the ugly geo and domestic politics, too much public and corporate debt, and shrinking global trade, just to name a few. These problems need to be addressed through structural reform, compromise, and cooperation, and cannot be fixed with simple cyclical monetary policies, such as interest rate cuts and more quantitative easing. The dollar may be the early warning signal for the beginning of this realization. There is obviously more than just that going on, as the following S&P versus 10-year U.S. Treasury note yields ratio drawn on a log scale shows. Falling Treasury yields associated with expectations for weak inflation and global central bank easing, along with the rebounding S&P 500, have pushed our ratio through our dome top. This is highly unusual and suggests major distortions are occurring along with heavy market interventions and, of course, accelerating de-dollarization. Our expectations are for the U.S. Treasury yield counter-rally, which will put in a right shoulder before U.S. Treasury yields head lower. This will be the result of 1. Political conflict, 2. Trade war inflation pressures, 3. Heavy U.S. Treasury supply, and 4. Weak foreign buying of U.S. Treasuries. For more details, see our recent post on the 10-year U.S. Treasury note hitting MATA SII's targets. We have hit the MATA SII yield target of 2.08 for the 10-year U.S. Treasury note. This is exactly a 61.8% Fibonacci retracement. Note that the recent TNX plunge was technically precipitated by the cross of the 80 weekly moving average in black and of the 40 weekly moving average in blue. Where do we go from here? From a fundamental perspective, the drop is about the plunge in inflation expectations, which is triggered by the drop globally of 5-year and the 10-year forward swap rates. Calls for the Fed to ease policy heated up on Friday after the official non-farm payrolls report showed the U.S. economy had added only 75,000 jobs in May, falling short of analyst estimates of 180,000 jobs. Banks are rushing to cut their year-end forecasts for the benchmark treasury yields, but Commerce Bank might just have topped them all. Here is what they say, and I quote, "The contention is that once the Federal Reserve embarks on rate cuts, it would move more aggressively than investors expect. Once slowing economic growth and tariff fears force the central bank's hand, the 10-year Treasury rate would fall towards a record low of 1.25% by year-end," at least written by Christopher Rieger, who is the head of rates at the bank. Yields fall as bond prices rise. Again, to quote him, "Our Fed view with 3 25 basis point rate cuts by March 2020 is close to what the market is pricing. Once the Fed begins easing, however, the market will not stop there. Following the comments at this week's Fed conference, it should account for a scenario of more aggressive preemptive steps, which looks like it's set to take the U.S. Treasury yields to record lows," as he continued. That is Rieger, head of rates at the bank. The U.S. Treasury market is following the global move based on rapidly falling trade statistics and the shift of central banks to an easing bias. Our position is that we continue to believe we now have begun to see a counter rally begin or shaping up, which will put in a right shoulder, that is, an increase in yields, before this U.S. Treasury yields head lower, as Rieger's comments suggest. The S&P 500 has now broken back above its 50-day moving average. As you can see, we feel this is part of a consolidation pattern with a lower low still ahead. You'll notice we are labeling an inverse head and shoulders. We think there is a real possibility of this with new highs in Q4 above 3,040 and possibly as high as 3,200. This will complete the topping process. The Dow Jones Industrial Average, shown here by the DIA, has the same potential. The current strength in high yield and the availability of credit since the lows give us a degree of confidence in this call. The 50-day moving average is now above the 100-day moving average, which is above the 200-day moving average. This is quite remarkable considering the lows we saw in December 2018. Both junk bonds, that is the red line in the charts, and the market breadth, black line in the chart, suggest that the S&P will be making a run to at least the low 2900s. The big emotional trading drivers for the stock market are hopes of a trade deal between China and the U.S. at the G20 meeting in Osaka, Japan, and hopes that the Federal Reserve will cut interest rates this month. The Fed cannot cut rates with the S&P 500 within 5% of its all-time highs. Yes, the Fed is now in the stock market promotion business, but cutting rates with stocks above 2,900, that seems a stretch, which means a crash is coming, but not quite yet. Likely starting in late fall, that is, the dominant move down, or early 2020, as we head for the U.S. elections. Bringing Fed open market operations, that is, FOMO, back will be with the expectations that this will usher in a new era of record highs, and central banks are once again stepping in at the right moment, trying to prevent another key break in stock prices. One is virtually enticed to chase assets again for that big grand finale, perhaps, not because of earnings, not because of revenue growth, but because they have to, as yields are once again collapsing and central banks are again promising free money. As I've outlined for quite some time, stock markets can't sustain gains or record prices without intervention, without a helping hand, without dovish and intervening central banks. This has been true for 10 years, and it continues to be true in 2019 because that's where all the big gains are. This is not capitalism, nor does this ongoing farce constitute free market price discovery. It's Politburo based central planning, desperately trying to keep the balls in the air. Since when is this the primary purpose of the Fed? What happened to inflation and price stability? Already they are tossing their stated inflation goals and talking about letting inflation run hotter if they can juice it up. There's no integrity, only moving targets and carrots driven by equity prices. The pretense is gone. It's all about keeping the illusion alive that the Fed knows what it's doing, that it's always there to save markets from any trouble. But its track record is obvious. It has failed to meet its inflation targets, ill-guided as they may be, for 10 years. It has failed to normalize despite years of promises to do so, and will never be able to normalize. Between 2008 and 2019, the Fed was non-accommodative for only 3 months. It blew up in their faces in December. They'll never be non-accommodative again. They can't. This week, investors are happy to chase the coming free money train again. They may well be rewarded for the same gig that has worked for 10 years with the consequences already apparent. Ever more record government, corporate, and consumer debt, and yes, even more extreme wealth inequality. Bravo. Alternatively, investors may want to exercise caution in chasing policy failure, but rather keep an eye on technicals that may well point to a different result. The megaphone is quite pronounced, but it doesn't come without short-term risk. The risks are antitrust probes of major techs, big bets on falling rates, and inflation expectations, all misfounded. We need to worry about tech stocks now being on regulators and Congress's radar. Antitrust legislation will be disruptive. Techs not being valued by profit or profit potential, that is similar to what we saw in the dot-com era. Profits come from those trying to protect their moats, and most of them are forced to acquire others for preventive damage reasons. There is a misplaced bet, in our opinion, on falling Fed funds rate keeping the equity markets from falling. Anticipation that the U.S. stocks will rise once the Federal Reserve begins reducing interest rates is at odds with recent history. Data compiled by CFRA show the S&P 500 index fell 12.4% in the first 6 months after cuts started in 2007. The drop broke a post-World War record of 9.5% set in 2001 when the central bank's previous series of reductions got underway. Declines in the S&P 500 have also followed moves toward lower rates that began in 1960, 1968, and 1981. Another setback may happen this time if the Fed decides to cut rates prematurely, at least according to Sam Stovall, CFR's chief economic strategist, in a report he wrote on Monday. Thirdly, we believe we see false inflation expectations, which could change suddenly and dramatically. We expect that. We highlighted these two dates in previous months. They turned out to have signaled the recent highs in the market before approximately 225 S&P drops occurred in May. In summary, we're clearly in an era of ongoing intervention. The central banks are going to do whatever it can do to stop a recession. Of course, they'll fail. But as global systemically important banks approach their previous lows, I expect the intervention to be massive, coordinated, and more than just quantitative easing. QE won't work this time, but we'll save that discussion for another time. As I always remind in these videos, remember, politicians and central banks will print money to solve any and all problems until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of unsound money and fiat currencies. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2019 be an outstanding investment year for you and your family.